Hey guys, what's up? I'm Erin and welcome back to the channel. Last year, the market ended in the red. S&P down about 20%, the Dow down about 9%, and the Nasdaq closed the year down about 32%. Unsurprising, 2022 was the worst year the S&P has had since 2008, and the fourth worst year the index has had since it was invented in 1957. Okay, so we know it was negative, but I'm a glass half full kind of person. So let's temper that negative news with some positive news. It is very rare for the stock market to have consecutive down years. Not unheard of, but rare. As I said, the S&P came about in 1957, and since that time, the index has only had 18 times where it was negative. And of those 18 times where it was negative, on 14 occasions, the negative year was followed by a positive year. So if we were to throw a percentage into here, we could say that roughly 80% of the time there is a negative year, it is followed by a positive year. And what about those 3 times where the market didn't turn positive the following year? They were 1973 and 1974, then in 2001 and 2002, and again in 2003. In each of those cases, the market actually did worse in the subsequent years, the second year and the third year. So it feels good to know that while the down years themselves are fairly infrequent, back-to-back down years are even more rare. And when the market rebounds, it tends to rebound in a big way. On average, the return in the year following a negative year or a down year is actually a positive 15%. So what does all this mean? Can we expect 2023 to turn positive? Who knows? We can hope, but we still have significant headwinds that we're facing. Namely, those being that COVID is still having a big impact, especially in China. And as the Chinese economy gets disrupted, it causes disruptions on a global scale, as we live in a global economy when we're all fairly interdependent on each other. And as long as that continues, we will continue to have sourcing and supply chain issues. The war in Ukraine continues to wage onward. That too has global ramifications. And inflation, while definitely down from peak levels, is still quite high. And I know we've all felt inflation at the grocery stores, but lately it's coming hard for eggs, which honestly breaks my heart a bit because eggs are one of my favorite foods. It's not great timing when inflation is already causing price hikes and then a bird flu hits. The consequence is we now have eggflation, and a dozen eggs now cost at least $5 a dozen. And doubling down on the home front, US politicians are debating the debt ceiling, which is an issue in and of itself that is known to cause a turbulent stock market. So ultimately, we're still facing some pretty significant issues, which could further tax the economy and eventually push us into an official recession. If that happens, consumers may be forced to reduce their spending. This would reduce the profits of businesses, and thus we could start to see unemployment start to tick upwards. All of these are net negatives for the stock market, and if they were to happen, we could very well see another negative year with the stock market. Perhaps it's worth taking a moment to consider that the times where there were prolonged down periods or sequential negative years, those times coincided with deeper recessions. So really, perhaps much of this hinges on what the NBER says about our economy this year. Do we enter into a recession, or can we skirt past it? The future's unknown. You can't predict with any level of certainty what will happen in the next few months or few years. The best thing you can do for yourself is create an all-weather portfolio, one that can withstand the upswings as well as the downturns for whatever the future brings. And when you're creating a portfolio like that, there are some guidelines to follow. Make sure you're investing for the long term. When you're investing for a future that is 20, 30, or 40 years down the road, you want to have a solid plan. You want to have a guiding set of principles. The last thing you want to be doing is investing on a whim. You don't want to be buying or selling stocks or options or whatever the investment might be simply because you saw a headline. Headlines sell stories. They do not highlight solid investments. Safe to say that no matter what is said in the news or in the paper, it should not affect how you are investing. When you're investing, have a plan in mind. Get rid of the idea of getting rich quick or getting rich overnight. That is not reality. Wealth takes time. It takes a lifetime to build. It doesn't happen with a single decision or with a single stock. Ultimately, you just want to sit back and enjoy the journey. ABB, remember the acronym, always be buying. When the market goes down, you're still buying. At that point, you're getting shares of great companies at reduced prices. You're getting stocks when they're on sale, and that's a reason to celebrate. And then when the market goes up, you're still buying, because where the market is today, even when it's up, is likely significantly lower than it will be in the next 5 years or the next 10 years. When you hear people talk about investing, one of the biggest regrets you hear is, I wish I would have started investing sooner. This is how you get around that. No matter what stage of life you're at, no matter what the market is doing, always be buying. Even if it's just a small amount, make sure you're still investing. And as you know, one of my favorite ways to do this is dollar cost averaging. Make it automatic. Every single paycheck, a set amount goes into the stock market. This really removes the emotion from it. And honestly, one of the best things you can do when it comes to investing is check your emotions at the door. Diversification is your friend during market downturns. When the stock market is riding high, it can be tempting to think, I need to take every single dollar I have and get it invested and get it working and capturing this moment. I can't miss this. In those times, it can feel like a diversified portfolio is a bit of a bummer. But when the market takes a turn for the worse, when it turns negative, that's when a diversified portfolio really shines. A diversified portfolio protects your downside. We all remember Warren Buffett's infamous rules for investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. And diversification is a really great way to do that. Real estate, cash holdings, stocks, even making sure to invest within different sectors of the stock market. Yes, the stock market was down in 2022, but real estate across the nation on average appreciated about 10.1%. And government notes and bonds are currently paying 4 to 6%. And when it comes to the stock market itself, not all sectors were clobbered in 2022. The NASDAQ, which is notoriously tech heavy, reported significant losses, coming in at a negative 32%. But the utility sector was mildly up, and if you would have bought the Vanguard Utility ETF, you would have been up 1% for 2022 in that ETF. Having a balanced portfolio would protect you from having a down 32% portfolio as if you just had a NASDAQ portfolio. Making sure you had some exposure to real estate, some high yield savings, some government notes, and yes, making sure to invest within different sectors of the stock market. That protects you from feeling the brunt force of one sector's downturn. It's worth mentioning, when tech had its surge in 2021, you heard about people doubling or tripling down on their investments in that sector. That left them very vulnerable to what happened in 2022 when the tech sector got hit very hard. I know people who had a total stock market fund, which for all intents and purposes is every stock in the market, but then turned around and bought QQQ, which specifically tracks the NASDAQ. But if you had a total stock market fund, you already had every single investment that was in QQQ, or they turned around and they bought Tesla because that was the latest hype stock. But if you have a total stock market fund or an S&P tracking fund, you already owned Tesla. There's absolutely nothing wrong with deliberately buying shares of a specific stock, but just know that it creates concentrations within your portfolio. And if you're going to do this, you want to ask yourself, is this part of my deliberate plan? Or is this something that I'm doing that's more reactionary to what other people around me are doing? You want to have a diversified portfolio when the tide turns. Reevaluate your investments. Remember that you are constantly changing, and your portfolio has to work for you at this present time. How you invested at 20 might look very different than how you want to invest when you're 45 and you have a family to support, or when you're 60 and on the brink of retirement. Don't be afraid to make changes. Your risk tolerance may change over time. The amounts that you invest may change. Are you investing just for yourself? Are you investing for a spouse? Perhaps for children or next generations? How you're investing needs to match what your life looks like today, not what your life looked like a decade ago. So we'll see what 2023 throws our way, but with a solid investing plan, you should be able to handle whatever it brings. Let me know your investing plans for 2023 in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.